Hello, friends. Welcome to Nirmal Bang. I'm Piyush Jain, and today we are bringing to you a corporate conversation around an upcoming IPO. This company is into a sunrise sector, electronics manufacturing. Over the last many quarters, we would say we have been hearing a lot. Government has been trying to really boost Make in India in this sector. This is also a sector where there are huge imports. Imports, we are talking about almost $100 billion plus across the value chain. And there has been deep efforts from the government really to boost the hardware manufacturing, electronics manufacturing, PCB manufacturing, and the list goes on. So let's try and understand from the company today, the management today, Mr. Ganesh Venkat Krishna Bodanapu, the chairman and non-executive, non-independent director of Cyient DLM Ltd. Sir, welcome to the show.
Thank you.
Now, so Cyient DLM is basically enjoys the parentage of Cyient, but the more interesting and exciting part for our viewers and investors for this upcoming IPO will be the core business model. Electronics manufacturing, help us understand which part of the value chain you're addressing, what part of the entire business segment, is it only defense or there are also some other sectors, and also what is sort of inherent strength revenue model for the company?
Let me start by addressing sort of the where we play and what is the focus area that we have, because essentially our focus area comes really from the parentage of Cyient, which is, as some of you know, we are an engineering services company. We do a lot of engineering, which is essentially R&D, technology outsourcing, engineering design outsourcing, and so on and so forth. So where we saw an opportunity is there are, if you look at the industries that we work in, which is essentially very safety critical industries, very reliability driven industries, where product uptimes have to be in addition of 99.9999%, not just 97 or 98%. So we've built a strong lineage in doing work in safety critical, reliability driven industries. Then what we saw and where we saw the opportunity was that the products that we design also have to be manufactured, and the manufacturing is also as complex, as involved as some of the design that we've been historically doing. So the opportunity was to bring our sort of DNA, our credibility in design to manufacturing. So now to answer your question, that is really the differentiator that we've brought to bear. I mean, if you look at some of the industries that we work in, we essentially work in 4 sets of industries: aerospace, defense, medical, and industrial, because all these industries are really focused on safety, criticality, reliability, cost. All of that is important, but it's really about safety. In aerospace, for example, safety is paramount. You can't have an incident, much less an accident. So therefore, it becomes that much more important. So our differentiation really comes from our ability to manage this safety critical design in Cyient, but now the safety critical, highly evolved manufacturing in Cyient DLM, and that's what we want to build on. We believe that as we move ahead and as the industry or as we use so many more electronics in all applications, the demand is growing exponentially. Like you said, in India itself, we import in excess of $100 billion of electronics and electronics related equipment. But then that's suppose that if the government didn't do anything, it would have grown 3x. Of course, the government has done a significant amount of has brought in a significant amount of focus, be it the PLIs, be it for defense. A number of the systems can only be indigenously bought, 100 systems cannot be imported anymore, and so on and so forth. So we believe that positions us very well at the moment in terms of where growth is going to come from and what is our right to play and right to win in this growth environment and in this growth market.
Right, and having said that, what is sort of a major revenue model, sir? Like, are most of the contracts linked to the Cyient clients, or it's like an integration to the, as you just spoke about, it's an integration to the earlier offering, or there are also some very dedicated manufacturing long-term contracts which are coming up? How the sort of revenue model? Is it like a more back-ended model, or there are sort of equivalent cash flows? Help us understand that.
So, that's a great question. I'd say that we've leveraged the Cyient DNA, the Cyient Connect, and the Cyient parentage in a number of our deals. But I think the biggest thing that we've leveraged is just our credibility, right? We have a number of common customers, not necessarily, a common project where we've designed it and therefore we're manufacturing it. The entire value chain of design to manufacture is still relatively small, and we believe that will continue because even if we're doing the design and manufacturing on the same product, our clients typically like to have a break because that's the validation phase. That's where their value addition really comes in. So they will do separate contracts between design and manufacturing. So in that sense, we've leveraged Cyient's credibility. Of course, we've leveraged Cyient's contacts, but much of the business is independently won. We have a number of common clients, but right now the contracts with both entities are separate because if nothing else, the nature of contracts also tends to be very separate, and how contracting works in both these businesses, also tends to be very separate. So the contracting is very separate. But typically how it works is we've been able to leverage the Cyient pedigree, the Cyient DNA, and our connects into this business. Now, much of the cash flow is quite linear. Typically, if there is a lot of material that we have to purchase, customers more often than not have an advance model, so they'll give us an advance to purchase the material. The value add, of course, is where we come in. We bring in our differentiation. We bring in our processes and tools. So therefore, typically the differentiation is, there's a different way that both things get contracted. But it's a good model where, if you look at it, our days outstanding are actually down to about 70 days on a steady state. So it's a good model of how cash gets converted, or value gets converted into cash.
So just to confirm, it implies that largely raw materials, anything, you actually get upfront advance. So from a cash flow perspective, perhaps after a particular stage, it's more about sort of accrual for you.
It could be, but typically it's still, there is still a fairly significant value add that we provide. It's just for some of the key components we get advances, or some of the risky components we get advances. But it's a good cash flow business. I'll put it that way.
Sure. Now, my attention actually went to the order book. Again, there was some really big up move happening in the first 6 months of FY23. I was actually looking at the numbers of March FY22 around basically, and from there, if I look at the September numbers, it was almost 100% growth. So help us understand from a vertical perspective what happened in industrial aerospace divisions. Were you able to really win some significant material orders, or the capacity was increased? And then eventually I'll go down to my next question, which is about capacity. But what happened to the order book?
So I think the order book is really a function of sort of the credibility that we've built, and just the cycles, right? I mean, if you look at some of the orders that we're winning right now, we started working on these orders maybe 2 or 3 years ago, even, because there's a whole cycle that you have to go through in terms of making sure that the right tools, the right machinery is there, the right processes are there, the right special processors are there, and many other things after that. So I think the order book is just a function of the work that we've done. I would say it's just coming to bear right now. And having said that, there is 3 elements to an order book, right? One is what we reported, which is the 2,500 crore number, which is essentially there is a purchase order. It's backed by a firm date. It's backed in many cases with advances and so on and so forth. Then we have what we call total contract value, which is many of these contracts have a 15, 20-year life cycle. So we know what we will make over the 20-year period. And of course, that's now it starts to get into some very large numbers, because we can't call it an order yet because there's no purchase order. But that starts to get into a very large number. And of course, there's the pipeline, which is the potential orders that we will win in the next couple of quarters. So I'll say the combination of all three is looking really good. The order book is obviously very, very strong, like you pointed out. It's doubled. We will continue to see good growth in order book over the next many quarters, actually, because there's a lot of things in the pipeline are starting to come into orders. So we'll see that, and also the ability to execute exists. I think maybe just jumping into your question about capacity. Right now, we still have capacity for about 3x of what we're delivering from a revenue perspective. Just looking at the various missions, the various things. So we feel quite confident that at least in the next, the current momentum will run into the next 24 to 30 months, both with the orders and the ability to execute.
Sure, sir. I have a follow-up interesting question, and that would be in defense. It is always interesting to ask is what's the order pipeline looking for you, and most important, usually if it's a OEM or a large company chasing a very large order from the defense forces, it's not a like 1 month, 2 month. Sometimes it takes 4 quarters, sometimes 8 quarters. They have a long time before they win the order. Like, what's your that average time window, and what is the size of order pipeline according to you right now?
See, pipeline is in excess of $1.1 billion, so we should be pushing about 10,000 crore pipeline overall. Now, to your point about defense, you're absolutely right. If you look at, like I said, if you look at some of the orders we won in the last year, we've been working at them for the last 3 or 4 years, even though maybe not 4 years, but 2 to 3 years. So I think the good news, and that's why we also honestly feel confident about now going into the public markets, because that has become a continuous process. We're winning orders today, which we worked 2 years ago. We'll win orders 2 years from now that we're working on today. So I think we just have to be realistic on that expectation that defense orders do take time, because even once you, I would say it typically takes a couple of years to win an order, but also it takes a couple of years after that just to do the pre-work, because you'll have to do engineering, you'll have to do testing, prototype. So I think all that is has been going on for 5 or 6 years now. That gives us the confidence that it will continue, and we're in a good glide path or a good roadmap towards continued growth.
Sure. So one short question: average win rate for you, 10%, 5 to 8%. Like, what would the average win rate versus order pipeline?
See, our average win rate is typically 50-55%, but I'll qualify that by saying we are also very careful in choosing what we go after. We know where our strengths are. And, I think our sales team has done a fantastic job in building relationships where, before going and quoting for something, we'll know what exactly it is. And we'll also know our chances of winning. So I think we have a very mature sales team that takes into account. And that's why, another way to look at it is if we lowered that threshold, we'd probably win even more business. But I think this is a good way right now that we have great relationships and we're able to sort of understand things before they happen.
Sure. So did I hear the number right? Did you say 50%?
Yeah, it is 40 to 50% the win rate, yes.
Oh, okay.
And again, I'd say that because we're very choosy in terms of what we go after.
Sure. Understood. So that's on the sort of numbers here. One question also around the sort of profit margins. We have seen companies which have some technology advantage, or they basically are operating in some niche. In defense, sometimes they operate very, very strong double-digit margins. What are sort of average EBITDA margins you command, and net profit margins? I was looking at 4%, maybe plus minus 1% here and there, because the product mix would be changing. But what is sort of average EBITDA margins you're commanding?
So right now, our EBITDA margin in FY22 was about 12%. In FY23 was about 11%. But the drop is also because of SG&A investments. Our gross margin is still quite strong, and even year on year, we're seeing good improvement in gross margin. So what right now, the SG&A cost is quite high for a small business or a relatively small business, because again, like I said, we've invested quite a bit in people, we've invested quite a bit in technology, and so on and so forth. So what we believe is our roadmap is towards a 10% EBIT, which again, I wouldn't say will happen this year, but we have a we have a roadmap towards that over the next few years, and that will lead to about a 7-8% kind of a net margin scenario if we are able to be prudent with our capital structure. One of the reasons why we're also raising equity is, the cost of debt where it is right now is it's not a very good time to just load up on debt at the moment.
Right. Yeah, almost 300 crores of debt you already have on the books, I think. But I was just thinking around, if you are only at one third of capacity, which implies you can increase 3 times the revenue before you need to increase any capacity. So if you're just able to load up your utilization, the margin should automatically inch towards your target. Maybe another
Yes.
4 or 5 years before you're able to go to 100% utilization. Like, correct me if I'm wrong. Those margins should be easily achievable then.
Yeah, absolutely. That is. See, there's a couple of things that will happen. One is the absorption and the capacity will give us this, this margin. The second thing is also the whole B2S. B2S is essentially where we do the design and the manufacturing together. We're seeing right now it's only about 4-5% of our overall, maybe if that. But the pipeline has about 20-25%. So as we do more B2Ls, we also have a lot more control on what components we use, where we source them, and therefore we can, we can get much better deals on the raw material. So these are the two reasons why we're quite confident that margins will only improve in the next few years.
Okay, sir. Please sort of tell our viewers about the IPO. Like, the numbers which basically we have is the IPO basically is opening around June 27, dear viewers. Closing around June 30. Listing is aimed at July 10. The good thing about this IPO is that entire offer basically is fresh issue. The money is going into the company, and obviously basically that is going to support the growth here. Also, price band has been fixed at 250 to 275, and the issue size, sir, is around 740 CR.
It was 740. It was reduced to 700. Just various logistics reasons, it was reduced to 700. And the price band is 250 to 265, I believe.
Okay, 250 to 265. I stand corrected. And sir, perhaps as we move towards our last questions, fund usage from the funds which we are raising from this IPO, because it's fully fresh issue. What will be the fund usage?
So there's 4 things that we'll use the funds for. The first is we have external debt. We won't pay back the Cyient debt, but we have external debt. We'll pay that back given the where the interest rates, etc. are.
How much that is?
I believe that's about 150 or 160 crores roughly.
And how much cost that would be?
I don't have that off the top of my head.
No problem. Please proceed.
In the 9-10% range. The second is working capital. We'd put about 300 crores into working capital, which is what we would need over the next 2 years or so, just to fund the growth. I mean, our aim is to get to capacity utilization, much quicker than a 5-year timeline. So we just need to make sure that we start to fund the associated, which is things like working capital. The third thing is we will continue to invest in some of the sales, the technology, etc. So there's a bit of capital that will require there. And the fourth element is the acquisitions. Right? We have some good capabilities. We have some, obviously, we just talked about capacity utilization at 1/3. But there are also some capabilities where we have a gap. Like if we do box build, which is a higher value, we'll also need to have some capabilities around the mechanical element, which is the plastics, the sheet metals, etc. So there's some capabilities that we'll need to acquire. Also on an associated path or an associated matter, I would say, is we need to build a little bit more manufacturing capability, especially from a final assembly and storage logistics perspective, in near our customers. So we've earmarked about 70 crores for that. So these are the 4 things: payback debt, working capital, investments, and potential acquisitions.
Sounds good, sir. I'll close with my one small question, because your numbers excited me, and I wanted to ask, if you're paying up 100 crore debt, 8, 9, 10%, whatever the interest cost, would it be fair to say that we are talking about almost 8 to 10 crores of interest saving? If I adjust for the tax, that would be still around 6 to 7 crores of net profit addition. and versus the 32 crores profit, that looks like a good significant delta.
No, absolutely. I think that definitely helps us with the finance cost, because we can use that to really invest more into the business. But I mean, yes, the math is correct, but we're working on how we can quickly and effectively deploy the rest of the funds also.
Okay, sir. This indeed looks a very interesting business, in sync with the government policies, in sync with very large capex which the government is putting up, and you basically are increasing sort of your capacities or capabilities. Perhaps something which our viewers will take sort of keen interest in understanding the business. Thanks a lot for coming on our show, and from our side, we extend all the wishes for a very successful IPO.
Thank you very much, and thanks for giving me this opportunity to talk to me this afternoon. Thank you.
And with that, dear viewers, it's a wrap on the show. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.